earnings are incredibly important. I mean, it gives you a confirmation of your long-term thesis, right? So the stock will trade off of whatever the most recent data point is. So it's always it's a struggle between your long-term and short-term thesis, and you could have a quarter that goes against you in the near term. Maybe they miss estimates or growth comes in a little bit light, but over the long term, you have to really contextualize that. Has my thesis changed? That's kind of.
Yeah, I would agree with you 100% on that one. I mean, I think the one thing that we think about every time that a company reports is, has the story changed? Mm-hmm. So, there's always going to be little data points, even intra-quarter. And like you said, this is a confirmation of what's happened for a 3-month period. And then you get kind of an outlook as to what's going to happen over the next 3, 6, 9, and 12 months. But, as we look through the numbers every time they come out, it's okay, has a thesis changed, has a story changed, and if so, what does that mean to either our conclusion or is it a name that we're interested in? So not only are you looking at names that you're currently involved in, but you're also sourcing other ideas because it's the most recent data point. So that's the way that we look at it in retail.
Yeah, and I think you gotta have to kind of pull bigger picture and see if you have multiple quarters of data that's going against you before you have to really sit down and reevaluate your thesis and see where you're wrong, basically, before you make a bigger decision. Yeah, I mean, consensus is a huge factor, right? I mean, all else being equal, if you look at a company in this market that's growing organically, let's say 20%, on an absolute basis, that's really great. It could be in line with their guidance, or it could be even a little bit higher than their guidance. But if consensus estimates was looking for 22% growth, right, all of a sudden, that 20% doesn't look that great. So, it's that absolute versus the relative perception. So whenever you're looking at a company, you have to factor in where consensus is at. And I think in formulating your long-term thesis, you kind of look at where sell-side estimates are relative to where you think they could be. And obviously, if you think they can beat, then that's a positive catalyst, and vice versa.
Yeah. I mean, if you believe in efficient markets at all, you got to believe that consensus estimates matter. Now, there's times where stocks will trade off into a print, and I would say consensus estimates don't matter as much, or maybe there's something else under the hood that's going on, whether there's worries about what the guide's going to look like, or people had expected a big deceleration, and maybe it's not reflected in consensus numbers. That happens every once in a while. Mm-hmm. But the one thing I will say about consensus numbers is that they don't vary too much from what the company outlook actually is. So if you kind of look at let's say a bucket of retailers over 2015, and you just say, okay, I mean, how many of these guys actually hit the consensus number that was set at the start of the year? Mm-hmm. Maybe 2 handfuls, maybe a dozen. Yeah. That's about it. So I think the point is that why we have jobs is because not only do we have kind of a feel for what's going on intra-quarter and intra-year, but also kind of what the building blocks are on 1 and 2 year basis. Yeah. So then you can understand what the longer term outlook is, and be insightful in that way.
Mm-hmm. Yeah, I mean, there's not much to add to that. It's obvious as efficient markets, as Alex said, stocks trade to align into what consensus is thinking. Mm-hmm. So to the degree that they hit or miss those estimates, the stock's going to trade. But there's obviously a buy-side sentiment that isn't always put into consensus numbers. That it's, again, as why we have jobs, is try to read that buy-side sentiment to see what the actual traders are thinking about in a particular name. So
yeah, I mean, we look at short interest, right?
Yeah.
Like short interest is probably like your number one indicator of where you are or where the buy side is versus consensus. I can think of a handful of stocks where the sell side's 100% buy ratings and short interest is 20%. So obviously there's a disconnect there, and I think it kind of goes back to your point where consensus estimates never stray far away from where management's guiding for the year. And in some cases, it's pretty obvious that, if they missed estimates for the first 2 or 3 quarters of the year, right, and they're maintaining their full year guidance, everything gets back-end loaded. And if management doesn't adjust, consensus estimates usually stick around in that same area code. And if they miss, it's kind of, usually that's when you see short interest go up. So.
Yeah.
Specifically in the restaurant space, I like to look at the top line and dig into the comps a little bit more. So you obviously have traffic and price and then a little bit of mix. So to the extent that a company can drive traffic, that's the strongest indicator of a strong concept. And to the extent that they can add price on top of that and really drive top line growth. That's what we really like to see in a strong company that we'd like to go along. So that's something we dig into. And then also, how are the margins doing? Are they improving margins from quarter to quarter and year over year, just to, because that's a continuation of how they're growing earnings over time. So those are two important things I'd say we look at.
Yeah, I mean, in healthcare, it's pretty much, each company is different in a lot of ways. So in the hospitals, we look at same store admission trends, what's ER volumes doing, margin, staffing costs, supply costs, et cetera. And that admissions number is a huge driver of what the stocks ultimately do. So we kind of key in on that, and we have some high frequency data points that we look at to try to give us an edge there. And then for some of the healthcare IT related names, bookings and backlog are huge. That's going to be, your bookings number is going to be what ultimately drives your top line. So it's a good leading indicator. And then for other companies that are a little different, like I think of an Athena Health that provides a quarterly doc ad number because it's a subscription model. So obviously, what did the doc ad number do in the quarter relative to consensus? So different companies, different metrics, but I think overall the same underlying theme. What's organic growth look like? What are the margins doing? What's growth doing on a rate of change basis?
Yeah. I think in retail, like you said, there's a lot of different companies that we look at. So we look at brands and both brands and retailers. So, earnings is the bottom line. For us, it's sales, comp sales, whatever you want to call it, depending on what you're looking at. Because, the rest of the P&L is going to leverage based on what you do on the sales line. So, it depends on what kind of investments you're making under the hood. But usually if you have a strong sales number, then the rest of the P&L follows.
So how do retailers work on refining their labor costs? So just for instance, in my sector, in the restaurant space, there's a lot of worry about wage rate inflation going into 2016, and it's obviously happening on a state by state level across the country. So how do retailers think about that?
Well, I think the good ones, they'll think about it, and some don't. So that's kind of
like
just
don't even think about it.
So I'll just say that if you got Walmart, which is the largest public sector employer in the United States, taking wages from a minimum of $7.25 to $10 across the board, I don't think it matters what the states do, right? So I think what you've seen Walmart, you've seen Target, you've seen TJ Maxx, you've seen Gap, all take wages up to at least $10 an hour. And I think there's a trickle-down effect across the rest of the space. So I think if you look at any of these organizations and their payroll, they're about as efficient as they can get, especially the big box guys.
Are they taking any price? Or are they trying to do anything to offset that?
It depends on who you're talking about.
Yeah.
If you were talking about a department store, just look at the inventory levels and the discounts that you saw when you were in the mall this year over holiday. I think that speaks for itself. So you're kind of working in a deflationary category where everybody's competing for sales in a space which is a department store space, which has been in a secular decline for 20 years, and you're trying to offset higher wages. You have a 100,000 square foot store. You can't have less people in it. That'll just make less people come into your store. So I think it's something that's really hard. And you saw it with Walmart. They invested about, I can't even remember the number now, but it's something like $540 per employee across 500,000 employees.
Yeah.
And those are just rough numbers, because I don't have my trusty computer here in front of me. But it's something that's going to trickle down to everybody. And it's not just, maybe a Kohl's, which pays less than Walmart. It's, the Costco that pays $17 an hour because there's a competition gap, right?
Yeah.
So they got to attract the right kind of employee.
Is there technology to mitigate that, like self-checkout, or are people kind of maxed out on using technology to mitigate rising wage?
There might be self-checkout. That might be the one offset.
Is that the only thing?
But you can't make a machine fold a T-shirt.
Yeah, no, yeah.
Or at least pick
There's
it up
only
off
so
the
far
ground,
you can
right?
go,
Yeah. So
Yeah,
who knows?
Yeah.
Yeah, we have a bunch of different pockets. So you think about the athletic guys, the department store space, dollar stores, whatever you want to call it. I think one of the things in third quarter that was really interesting that we saw, and it was for the first time in a long time, is across the athletics space, you saw inventories just spike way up. So, I think the first domino to fall was Skechers because they report early in earnings season. And then you just saw it go across the space. Nike was high, Dick's Sporting Goods was high, Hibbett had high inventories, Finish Line had high inventories. So it's one of those things where it's one domino, and if it's a big enough player, then it can have a ripple effect across everybody else. So that's just one example. And I think the important part about earnings, and maybe we didn't hit on it, is just that, maybe there's a company that you're not particularly focused on, but you'll sit there and you'll go through the numbers just so you can get a sense as to what the comparable company that you do care about is doing. So it gives you a good sense and read through as to how the industry is trending.
Yeah, I mean, in healthcare, it's interesting because it's supposed to be a defensive sector, and a large part it is. I mean, I think you're seeing a lot of, the more cyclical companies, energy, industrials, consumer discretionary, having a tough time in this environment given the macro backdrop. And, healthcare is kind of held in there, all things equal. We're still seeing top line growth and earnings growth. I think what drives healthcare, at least in the shorter term, is a regulatory backdrop. So, for example, we had the Affordable Care Act, which drove a lot more of insured lives into the system who are very sick. So as a result, we kind of saw this bolus of demand that happened over a compressed time period, which as a result, you saw growth accelerate in the space and multiples expand. During this time, you also saw a lot of M&A, right? So, when we think kind of about the macro environment, we look at it in terms of a regulatory framework, and we're kind of seeing that play out over the last 2 quarters as growth has slowed on the margin. We've seen that play out in the hospitals, especially.
For drivers for the restaurant space specifically, looking into this Q4 earnings month that's about to come up, I'm thinking a lot of things are going to be spoken around the oil markets. So specifically Houston, there's a large focus for many restaurant companies in the Texas market overall and Houston more specifically, so that should be a topic. And then also on the QSR players, specifically the burgers, a lot of things going to be around value and what's value doing to their business. Is it driving the top line? Is it deteriorating the margins? And how are they picking up market share versus their competitors is going to be a big topic in the upcoming month. So.
And then one thing that's interesting about healthcare too, in terms of utilization, is that when you see increases in volatility and weak economic growth, you usually see an uptick. People feel bad generally, so they go to the doctor more, or maybe they're concerned that they're losing their job, so they consume a lot of healthcare because you obviously lose your health insurance if you're not employed. So that's just an interesting factor that we're keeping a close eye on, given what's going on in the marketplace.
Yeah. Do you guys focus on market share at all? I mean, and this is one thing that just dawned on me as we were talking about this, but obviously in the restaurant space, you have a few choices. Like you can go to Wendy's, McDonald's, or Burger King if you're looking for a fast food burger. I mean, I'm not as familiar with the hospital space, but I'm thinking about in retail, like there's some things that happen and it happen to everybody, but then there's also, share shifts. So I think, one thing you saw is JCPenney gave up $5 billion in sales from 2010 to 2012. Yeah. And, our thesis was that Kohl's is the biggest share gainer. And, so you see this market share shift coming back with, JCPenney outcomping Kohl's and Macy's over the past, year and a half. So
we definitely see that in our space. So yeah, for instance, over the last couple of years, McDonald's was giving a market share to the other major burger QSR companies. So Burger King, Wendy's, Jack, Sonic, and it's almost how much revenue they lost was an exact amount of revenue that the rest of the players gained. Yeah. And you're seeing that reverse right now as they've reinstated their value play and brought back all-day breakfast and improved the rest of their product offerings. So I think we definitely look at market share, especially in spaces like that.
Yeah, and probably in healthcare it's a little different, but when I think market share, I think about the hospitals, and so you have the HCAs of the world, which are the dominant consolidators, largest hospital operator in the publicly traded hospital operator in the country that has a really strong urban footprint. So they're in a really good spot in terms of being able to drive utilization and volume. Whereas you have weaker operators such as Community Tenant LifePoint, which maybe have a more rural hospital base. So when we look at the admission trends, you see an HCA doing much better than you would some of the weaker players. And again, it's just all about market share driving consolidation into these higher commercially insured markets. Yeah, I think the biggest surprise has just been, and this has a lot to do with the macro backdrop, it's just the price action and the multiple compression that we're seeing, especially for growth stocks. Even though, on the margin, the numbers aren't that bad, and maybe they're not even missing estimates, but they're still getting taken down with the rest of the market. So that's just like one thing that immediately comes to mind in terms of what really surprised. I think from a fundamental perspective, we had a good grasp on the companies that have reported, but really it's just been the price action that's been really interesting.
Yeah, I would say definitely the multiple contraction that we've seen in our space in companies like WhiteWave or Snyder's-Lance or UNFI has been kind of astonishing and somewhat surprising, although we did expect some going into a downturn. What we've seen is pretty remarkable, I would say. And then from surprises, emerging markets are getting pretty bad for consumer packaged good players. Mondelez had a pretty rough time in emerging markets, and I expect other companies to have rough times in there as well, as they've talked about in the past, is kind of deteriorating for them. So no huge surprises yet, but we'll see what happens next week.
Yeah, earnings season's not over.
Yeah, I'll add my 2 cents, which is obviously multiples, and that's obvious. But I'd say the things that we're focused on would be, one, it would just be what guidance looks like for 2016. So you had the NRF come out and say that sales growth in 2016 was going to be 3.1% at retail, and I think like the 10-year average has been 2.7%. You're obviously coming off, kind of a slowdown, especially in the second half. But now, the NRF, which is the big lobbying group, is saying that sales are going to accelerate meaningfully in 2016. So it'll be interesting to see how companies handle that. Do they think that the slowdown in the fourth quarter was just weather, or was it macro related? So if you look at consensus numbers, you see that consensus for the most part is expecting a big snapback in demand coming in the first half of the year. So it'll just be interesting to see where that all shakes out. And then the second part would just be what inventories look like, because we know the winter was warm, and we've had a few cold days out here in the Northeast, but not too many to speak of. So it'll be interesting to see what inventories look like, which in retail usually means high inventories, lower gross margin, because you get a discount to get rid of goods, especially ahead of spring. So those are the 2 things that I'm looking for.
What have you heard from management so far in terms of guidance? Do they think we're heading into a recession? Do they see a big slowdown happening? Obviously Q4 was light. What are they thinking going forward?
I think the trend overall has been to announce kind of okay results and then to guide down. So we've actually had a few companies report that haven't finished their fiscal year yet, and we're really going to start to kick that up here in after President's Day weekend. So we'll start to get the department stores, which is when I think we'll get a much better feel as to what guidance looks like across the space. But they're generally optimistic, I would say, which is a little bit surprising given what we're seeing, especially here at Hedgeye in the macro environment. So.
Yeah.